Hello everyone. Today we are going to discuss about Form 4952 Investment Interest Expenses Deduction. IRS Form 4952 determines the amount of deductible investment interest expenses as well as interest expenses that can be carried forward. The form must be filed by individual estates, trusts seeking a deduction for investment interest expenses. Certain expenses can not be deductible, such as home mortgage interest and qualified dividends. IRS has different rules taxpayers must follow depending on where the interest comes from, whether it is investment, personal, business, mortgage interest. If an investor pays or accrues interest on a loan, they use the proceeds of several different purposes. The taxpayer may have to allocate interest that the right interest rule is used. Who can file Form 4952 Investment Interest Expense Deduction? Investment interest expense deduction must be filed by individual estates and trusts seeking a deduction for investment interest expenses. That means if you borrow money for an investment, you may be able to get a tax break. You can claim the interest on the investment as a deduction. Interest income may result from money borrowed specially to purchase investments like land, articles, commercial or residential investment properties, stocks, or non-tax exempt bonds. How to file Form 4950? There are three parts to Form 4952. Part 1, Total Investment Interest Expenses. You can see, guys, Part 1. It is basically a single page form and it consists of three parts. Part 1 about total investment interest expenses, Part 2 net investment income, and Part 3 investment interest expenses deduction. So basically, in Part 1, here the taxpayer calculates the total investment interest expenses. In Part 2, this figure is calculated after adjustments are made following the input of your gross income from property held for investments. Part 3, here you calculate any disallowed expenses that can be carried forward to future years and you figure out the current year's net investment interest expenses deduction. The final figure from Part 3 is transferred to line H of Schedule A. So guys, you can see the final amount. This should flow to Schedule A. I will show you in our software. And guys, please remember that Form 4952 is available on IRS website. IRS limits the investment interest expense deduction to the investor's net income from an investment. Exceptions that don't qualify for Form 4952. According to the IRS, the following instances serve as exceptions to file the form. If the investment interest expense is less than your investment income from interest and ordinary dividends minus any qualified dividends. If you don't have any other deductible investment expenses, there is no carryover or disallowed investment interest expenses from the previous year. In addition, the following investment do not qualify, like home mortgage interest, interest used to generate tax-exempt income such as a municipal bond, interest expenses that are properly allocable to passive activities. The IRS defines these as rental activities or any businesses in which taxpayers do not materially participate, qualified dividends and long-term capital gains. Taxpayers are already receiving tax breaks on these items, which are taxed at lower rates than the most other income. Thanks to the alternative minimum tax, if you fill out one Form 4952, you will always have to complete a second one for AMT calculation. The AMT is designed to ensure that certain individuals pay at least a minimum amount of tax by adding back in items that may have been excluded from a traditional tax calculation. Investment interest is one of those deductions disallowed under the AMT. The instructions for the Form 4952 Investment Interest Expenses Deduction And Form 60 to 51, alternative minimum tax, individuals instruct taxpayers on how to compute correct taxes under the both systems. Ultimately, whichever of your Form 4952 shows the higher tax is the one you will have to file with the IRS. So now I will show you in our software about Form 4952, Investment Interest Expenses Reduction. This is our software Drake. So Form 4952, Investment Interest Expenses Reduction. This is basically included in Schedule A itemized deduction. I will show you that also. If you click to Schedule A, it will move to Schedule A, and you can see here Form 4952, Investment Interest. And if you double click, then you can report the investment interest expenses. The investment interest expenses paid to or accrued in 2020. Please go all the lines. Disallowed expenses of 2019 of 4952 line 7. Gross investment income. Net gain from disposition of property. Investment expenses. Guys, this is Form 1452 in our tax return. So you can see disallowed investment interest expenses from 2019 was $4,500. Investment interest expense reduction is ultimately $4,500. So this should flow to Schedule A. Here you can see Schedule A line number 9, investment interest, attached Form 4952, $4,500. So guys, I believe you have understood how this works. Investment interest is very easy to report. I have already showed you how to report, like the information we have. I have reported this, although these are hypothetical amounts. So before I wrap up this video, I just quickly recap what I have discussed. So IRS Form 4952 determines the amount of deductible investment expenses, interest expenses, as well as the interest expenses that can be carried forward. The form must be filed by individual estates or trusts seeking a deduction for investment interest expenses. Certain expenses cannot be deducted, such as home mortgage interest and qualified dividends. Investment interest expenses must be filed by individual states or trusts seeking a deduction for investment interest expenses. That means if you borrow money for an investment, you may be able to get a tax break. You can claim the interest on investment as a deduction. Interest income may result from money borrowed specifically to purchase investments like parcel of lands, commercial or residential investment properties, stocks, and non-tax exempt bonds. There are three parts of the form. Part 1, total investment interest expenses. Here the taxpayer calculates total investment interest expenses here. Part 2, net investment interest. This figure is calculated after adjustments are made following the input of your gross income from property held for investment. And Part 3, investment interest expenses reduction. Here you calculate any disallowed expenses that can be carried forward to future years, and you figure out the current year's net investment interest expenses reduction. The final figure from Part 3 is transferred to Schedule A. Line number 9. I have already shown you in the video that Okay, so there are certain limitations for Form 4952. Those limitations are if the investment interest expenses is less than your investment income from interest or ordinary dividend minus any qualified dividends. If you don't have any other deductible investment expenses, there is no carryover or disallowed investment interest from the previous years. The following investments do not qualify. Additionally, like home mortgage interest used to generate tax-exempt income, such as municipal bond interest expenses that are properly allocable to passive activities. The IRS defines these as rental activities or any business in which taxpayers do materially participate. Qualified dividends or long-term capital gains, taxpayers are already receiving tax breaks on these items, which are taxed at lower rates than other income. So guys, this is all about from 4952. I believe you have understood. Goodbye.